And basically, it's a social science model that basically states how the world works. And the model is basically a series of disciplines. It's basically an equation, but it's a series of disciplines within your business degree. And the goal of the model is to be able to predict the value of the equity. Not only the equity of your portfolio, but the equity of your real estate and your own personal human capital and your own human equity, along with the human equity around your family. Because you have to be knowing what goes on in the world. If you know that tax rates are going to go up, that's going to have a direct impact on the value of the equity, and the value of the equity is going to go down. If interest rates go up, the value of the equity is going to go down. If tax rates go down, the value of the equity goes up. If interest rates go down, the value of the equity goes up. So you have to understand that within each one of these disciplines, which is basically an equation, and in the social sciences, our models are extremely complex. We're not like the physical science models, the physics models, the chemistry models, where we have 5 models, 5 variables in the model, and they're all based on natural laws. In our models, we have 50 variables within each equation, and we have 11 equations. So we have 11 by 50 factorial that we need to solve, and we need to solve these equations simultaneously to be able to solve the movement of the value of the equity, of it going up or down. You have to understand the accounting. You got to understand managerial accounting, and you got to understand financial accounting. You got to understand how all the accounting data and financial ratios are rolled up into financial statements that are then used to be able to raise capital in the capital markets, either in the debt market, the stock market, or from individuals or pension funds, or from seed capital, angel, or venture capital. You have to understand the finance in the context of the economy. You have to understand what kind of economic environment in which your company and your industry and you exist. The economic environment is very different here than it is in Europe and Latin America and Asia and other parts of the world. So you have to understand not only the fiscal policies, but you have to understand monetary policy and how those decisions are going to affect economic outcomes and are going to affect your wealth in the end. You have to understand the political science and how policy is formulated, and how it's brought up either from the masses or formulated from Congress or brought to Congress by the executive branch, how the policies are debated, and once they're reconciled and signed by the president, they become law and then administered through the bureaucracy and through the public administration apparatus. Those policy outcomes are going to have a direct and indirect impact on you. If you know that these policies are being formulated and you do nothing about it, and you know that they're going to impact your client, or yourself, or your wealth, or your family, and you let it happen, that's basically negligence, and you violated your fiduciary responsibility by not notifying the client or notifying your family, or moving out of the way of the destructive aspects associated with those policies. And if the policies are actually benefit you, you have to be smart enough to move in the direction of those benefits of those policy outcomes and leverage those positive externalities so that you can lever up your own human capital and your own portfolio. The legal system and the political system, the economic system, is basically based on philosophical systems. And we are a Western European-based society. The philosophers that basically design the systems here in the United States, both legally, politically, and economically, were Jean-Jacques Rousseau, John Stuart Mills, Adam Smith, Immanuel Kant, and others that basically design the system in which we are basically exist currently today. In the system, if you go back in time and you've studied civilization and you've studied other civilizations, their institutional structures are very similar to ours, but they were theocracies. And theology were basically the systems that were put in place originally based on theological infrastructure and institutions to govern the society, but also basic tenets of theology such as ethics and morality and justice and equity, efficiency, were those that were handed down from the theological systems. This system works here in this society today because we have a psychological, sociological environment that's conducive to knowledge and conducive to economic and psychological activity. We are not in the Middle East. We are not in Syria. We are not in Iraq or Afghanistan. Imagine if you were studying in those countries right now. It would be completely impossible from a sociological and psychological standpoint to be even doing what you're doing right now. So the environment it has to be in place to be able to solve this simultaneous equation, solve for the value of the equity on an instantaneous basis. And how do you do it? Well, yeah, you can use supercomputers and cloud and high-speed data processing, which you can do right now. But when I designed this model in 1996, there was no cloud computing, there was no supercomputers. I mean, computing, processing, and storage have increased 25,000 times since 1996, and maybe even more. So you can actually program this and solve this. But really the computer that can solve this instantaneously right now in a second is your brain. Your brain is the most powerful supercomputer ever invented. You have the most powerful supercomputer on your shoulders right now. And if you don't realize that, you should realize that. And it's true, because you transact 1 trillion biological transactions per day. You converse and communicate with other people on a daily basis. That is an extremely complex and processing data intensive skill set. Your brain is so powerful that if you understand how this model works, it becomes the machine language in your brain, which allows you to not only collect massive amounts of data in an infinite storage capacity, but also to process the data rapidly so that you can retrieve the data, retrieve the information, pump them through the models, come out with the outcomes, and make decisive decisions very quickly, and know the decisions that you're making are correct. So the major takeaway from this model is it's basically a machine language. It's how the world works. It's social science. It's a complex system of institutions and equations. In each one of these disciplines, there's toolboxes with tools in them for you to be able to solve complex problems. The question is, do you understand that? And do you have the toolbox and the tools ready to go at all times? There's variables in one equation that are also in the other, so it's very dynamic. It's multi-institutional. It's a simultaneous equation solution. You have to solve to get to the value of the equity of the movement. You've got to solve the equation simultaneously. It's a multiple regression simultaneous equation solution. And it's biological processing with infinite storage and infinite data processing. The next model is organizational diagnostics and logic, organizational design, organizational navigation. How do you navigate through organizational structures? Do you know where you lie within the organizational structure? When you're talking to individuals outside the classroom and talking to professionals, do you know where they are within the organizational structure? Do you know their educational background, what their title is, what company they work for, what division they work in, where did they grow up, where did they go to school, do they have kids? All of those things are factors in understanding who these people are and why they are where they are within the organizational structure. And do you know where you are coming in the organizational structure, and can you plot out a navigational path for upward mobility? Or do you stay at the virtual team organic layer of the organization, or do you have aspirations to move up? If you have aspirations to move up and or work across teams, you better understand the language across the divisional and product lines. You better be able to understand and be able to communicate with people of power and authority at higher levels of the organization. Can you talk to the CEO, CFO, and CIO? Can you talk to multiple managing directors and EVPs across the organization? Because at some point in time, you may run into a glass ceiling or some kind of impediment in your upward mobility, and you have to decide, well, can I move laterally within the organization to move up? Or if I'm constrained or bottlenecked, or I do hit the glass ceiling based on some reason, am I ready to move? Am I ready to move to another organization or another division decisively to continue to arbitrage my human capital that I've accumulated within the organization? So you have to understand the organizational structure. You've got to understand that you move from the organic to the mechanistic, from the team level to the bureaucratic level, and how to navigate and how to communicate, and then to plot your path so that you can navigate through upward mobility. So the first thing you need to do is you got to do the organizational scan. When you're talking to somebody, first thing you got to do is figure out where they are in the organizational structure. You got to understand how the organizations are designed by industry and by organization, and why they're organized the way they are based on comparative advantages or disadvantages. You have to determine your location, and you got to determine the value that you're adding within the position, in the division, within the organization, and be able to articulate that constantly to get upward mobility and get the economics and or the accountability and responsibility you deserve. You have to understand how to arbitrage your human capital that you built and you accumulated within these organizations. You got to be willing to move, and you got to be willing to execute quickly. And again, know that the decisions you're making are right. You need to be able to communicate both vertically within the organization and horizontally within the organization, and you got to be ready to go. If the opportunity presents itself to you, you got to go. You can't stay there. You can't stay in a myopic organization. You can't stay in an organizational structure that's misaligned with the marketplace. You're wasting your time. And you'll probably get fired at some point when they do the reorg. You can move this around. You also got to plan. You have to have a plan. You can't not have a plan. Okay? If you have a plan, then you can work within the plan. If you don't have a plan, then you're being reactive. And that means that people will be able to manipulate you and get you to do what they want you to do and not what you want to do. So you got to lay out a plan. And your plan's got to be at least a 20 to 30 or 40-year plan. Now, I know that sounds totally ridiculous to do, but it's not ridiculous. Because 20, 30 years, 40 years is going to go by really quickly, and you're going to look back on your life and you're going to ask the questions, well, what if I had done that, or I wish I would have done that, and damn it, I wish I would have done that, and you're going to live a life of regret. So you have to make sure that when you make your decisions, you're making the right decisions, so you never look back on your life with regrets. So you got to lay out a plan. So here's the plan that I laid out. First is you have to get the bachelor's degree, and it's just like playing sports. The goal is to get down on the field and become a player, but the first thing you need to do is get into the ball game. And the way you get into the ball game is you got to get a ticket. And the ticket into the ball game is your bachelor's degree. Now, the impediments to the bachelor's degree and the things that are going to come after that is you're going to be competing against your time and priorities. You're going to be competing against family and friends. Maybe you have sports commitments, or you're in music, or your job, or school. You got to pick your priorities and figure out what you're willing to sacrifice to get you where you want to go. And to be able to communicate where you want to go with people is not going to be easy. Because we all have visions of what we want to do and where we want to go, but nobody has the attention span to listen to you. You can't do it in a 2-second soundbite. You can't even communicate what you really want in 2 minutes. If you're lucky, you got 20 minutes with people, and if you're really lucky, you got a couple hours or a couple days. But most people aren't going to give that to you. What they're going to do is they're going to look at you just as though they look at yourself, and they're going to wonder why you're doing all this stuff. In some cases, they're going to try to talk you out of it. If you're lucky, they will be your advocates and mobilize you to achieve what you want to do. And in the worst case, they will try to sabotage you in what you're trying to do. And then you basically have a decision to make. Either you let them sabotage your life, or you tell them what they want to hear, or basically you go around them, or you go through them. And you just say, get the fuck out of the way, because I'm going to go do what I'm going to do. So what I did, because everybody told me, it's like, what are you doing, Larry? Why'd you get 2 master's degrees and 5 master's degrees and 2 undergrads and a doctorate degree? That's stupid. You must know you really like school. How was I going to tell these people, these friends, these family members, that what I wanted to do was become a financial engineer and build financial product for large financial institutions, just like a scientist and just like an engineer? They can't even, most of my friends, family couldn't even comprehend what it is I wanted to do. So I just told them yes. Most of my friends, I just told them, I said, yeah, I like school, and that's it. And it was easy. I could move on. So once you get the bachelor's degree, and that could take 4 to 7 years depending on who you are and where you go in your economic and social situations, but once you get the bachelor's degree, you're within the 3 to 5 year, basically, apprentice period, or the internship or the associate period. You have basically 3 to 5 years, maybe 7 years, to really focus on your career. If you're an accounting major, you got to take down the CPA, you got to get your audit hours, you got to pass the exams. If you're a finance major, you gotta spend 3 years and get the CFA designation. If you're into product management or project management, you gotta go to the PMP Institute and get the PMP designation. Maybe you go to Microsoft or Salesforce and get your business analyst designation. I don't know what it is, but based on what career you have, you may have to get licenses and certifications to be able to do what you want to do. Commercial brokerage, on the real estate side, you got to get the agency or the broker's license. You want to manage people's money or go investment banking or go on the financial services side, you need your Series 7, 66 insurance license and annuity training. You have to get these certifications. So this period could last 3 to 7 years, but what you're doing in here is you're setting yourself up because you originally planned that you were going to go to a top MBA program or a top school at an Ivy League or the best school and the best program that you can get into, because when you were going through your undergrad, you were focusing on your GPA. You were getting the references, you were getting the statement of purposes, you were accumulating the knowledge. And 2 years before you applied to the school, you were already talking to people, looking at schools, figuring out exactly what it's going to take to get in and how you're going to pay for it. And if you want to go to these top schools, you got to get in the upper 90th percentile on the GMAT exam, the GRE, the LSAT, and if you get in the upper 90th percentile and you have the 3.6, along with the work experience, you're in. Okay? So once you're in, it's not even a 2-year program. It's only 4 semesters. It's 18 months. And you got the winters off and you got an internship. And 9 times out of 10, you're going to go to New York, or you're going to go to Salesforce, or somewhere. You're going to do an internship. And they're going to offer you a job at the end of the internship. So you already have a job after the first 8 months that you're in the program. Because most of the top corporations recruit from the Ivy League. And they take care of their own. So once you get the job offer, you're probably going to negotiate a buyout where they're going to pay for the last year of your MBA, and you've negotiated that they're going to take out the $75,000 debt that you just accumulated within the program. They're going to pay you back. You negotiated it. Also, how do you pay for it? I wouldn't even worry about the money. Most of these top programs cost about $150 grand. I wouldn't even worry about it. Because within these 3 to 7 years, you're accumulating savings, you're looking at grants and scholarships. Maybe you can get some of those depending on who you are. If you're lucky, you have parents that will throw some money in. You can negotiate with your employer to take out your education through bonuses and a buyout offer over some earn-out period. You can set up your own corporation for you entrepreneurial majors. You set up your own corporation, you generate revenue. You can pay for your MBA program in pre-tax dollars if you set up a C Corp. And then lastly, if there's a gap, you use bank financing. But again, so it's not the money. It's not the issue. It's getting the grades and getting in the upper 90th percentile to get into the program, and then getting through the program. And if you're really good, maybe you do an MBA JD, where you just do the JD. You do the JD, you get in the upper 90th percentile on the LSAT, they will pay for your whole law degree, if you do pro bono work. So imagine a $150,000 3-year law program, all paid for because you excelled down in here, because you planned on doing it 5 to 7 years in advance, because that's what it takes to get into this program. Once you get out of the program, you basically move into an associate apprentice program where you're working directly under an EVP, VP, and a managing director. Now here's the great thing about this, is you're going to spend maybe 3 to 5 years here. These people are extremely mobile. They want this position up here. They want to be in the C-suite. So if you work for them and you do a good job, when they pop out, you take their position. Now you've got upward mobility into the EVP, VP, and the MD position, because you basically position yourself to do it, and then you just take over when they leave. And then lastly, you may aspire to be in the C-suite, the CEO, COO, CFO, CTO, CIO, whatever the C is. And that's going to take a lot of commitment, and it's going to take a lot of sacrifice. It's not cheap. A lot of people have lost families, they've lost and gained a lot. It takes a lot. You give up a lot to get here. So 4 to 7 years, 3 to 7 years, 2 years, 3 to 5 years, 10 years, 20 years. Time goes by quick. So let's do the mathematics. You're 25 years old, and 20 years from now, you're going to be 45. 30 years, you're going to be 55. 40 years, you're going to be 65. It's going to happen quick. What's the economics around this? Well, let's say you make $100,000 a year over your career, depending on what it is. So if something was to happen to you right now, and you lost that 20-year period, the income to replace you, if you made $100,000 a year, is worth $2 million. $100,000 over 30 years is $3 million. $100,000 over 40 years is $4 million. So here's the reality of the situation. Currently, right now, you sitting in your seat, right now, right this second, you are worth $2 to $4 million, and you don't even know it. You are worth $2 to $4 million. Because if something happens to you right now or next week or something, your family, your parents who got you here get nothing. Zero. Nothing. Because you don't have life insurance. It costs $500 a year for $1 million for you. You're healthy, you're 20-something years old, $500, that's basically beer money. You could provide your family with $1 million, $500 a year for 20 years, guaranteed. If you're worth $2 million, that's $1,000. $2,000 can buy you $4 million over a 30-year period. If something happens to you, your parents and your family are taken care of forever. Professor Souza, I'm young, I don't have a family, I'm healthy, I don't believe in life insurance. I hear that shit all the time. And it's tragic because I've lost students, I've lost people in my life, and they don't have the insurance. And then they come back to me later after I tell them what they need to do and how affordable it is. They come back to me later after they get a pre-existing condition, and they say, tell me about that life insurance again, Professor Souza. And it's like, well, what happened? Oh, I got diagnosed with, type 1 diabetes or Crohn's disease, or I got cancer or something like that. I want to get the life insurance for my family. It's like, sorry, I can't help you. I can't help you. Because I can't get you life insurance with pre-existing condition. That's why you get as much as you can when you're young, and you get it done, and you make your family the beneficiaries. So if anything happens, they're all taken care of. It's the smart thing to do. And there's really no place in the capital markets where you can control a $2 to $4 million asset for 20 to 30 years for $1,000 to $2,000 a year. There's no investment. You can't beat the stock market, you can't beat the bond market, you can't invest in real estate. But you can buy a life insurance policy for $4 million, pay $2,000 a year for 20, 30 years, and if something does happen, everybody gets taken care of. Nobody's left behind. So the takeaway here is 20 to 30 years goes fast. You need to plan and stay on track. Do not worry about the money. Do not worry about the money. It's not about the money. Shoot for the best school, shoot for the best program. Do not let anybody get in your way. Go through them, go around them, but always be going forward. Do not stay in one place. Always be constantly working to better yourself. The next model, which is the social learning model. This model was taken from Albert Bandura from Stanford University, who wrote books on social learning, self-efficacy, and modeling. A lot of this is based off of B.F. Skinner's work and Maslow's work, but what I did is I took their models and I basically modified it and created my own psychological model. And basically the model basically states is you currently right now are at the actual psychological state. You are right now in the actual state of your own psychology. But I know all of you have some aspiration and some vision and some animation of who you want to be and where you want to be in the near future. And that's really going to be your ideal self, which really is your target self. And the problem is that your ideal self and your target self is not your actual self currently. So there is a gap. There is a cognitive dissonance between the actual and the ideal self. The question is, how do I get from here to here and narrow this gap, this cognitive dissonance? And the way that you do it is through the process of self-efficacy. The process of self-efficacy. And the process of self-efficacy is, I know what my ideal and target self is. I know where I am today. I know I want to narrow this gap. But I know as I try and do these things and I try to narrow the gap, I'm gonna fail. Because the failure in the process is not a genetic predisposition, but it's actually a lack of information. And what you need to do is to identify models around you that have attributes that you want to emulate, to create a target self that will become the ideal self, that then you can narrow the gap through the process of self-efficacy. Now, self-efficacy basically states that I have an ideal self, or I need to get an upper 90th percentile on the GMAT, or I gotta get, you know, a 3.6 or 7 GPA, but it's really hard for me. But when I try to do these things and I fail, I'm not failing because of genetic predisposition. I'm failing because of lack of information, or lack of experience, or lack of persistence, or lack of motivation. So I've come across two types of individuals. I hear this stuff all the time. Oh, Professor Souza, you know, I really like the math. I want to be an analyst. I'm a scientist. I really like the numbers. I really don't like people that much. I want to work in the back. I want to work on my own. I want to work on these numbers. I want to do the analysis. I'm really good at it. My family was really good at math. I'm really good at math. I believe I have a genetic predisposition for math. Math comes easy. I've seen people become extremely successful in it. I'm going to go in that direction, and I'm not going to deal with any of the sales and management stuff because I'm not a people person and I really don't like people that much and I can't really interact with them. Then I have the other people over here that say, oh, Professor Souza, I'm really good with people. I want to be a salesperson and a manager. I'm great with people. I really don't like math. I'm not good at math. So I want to be over here. I've seen people around me. They've been successful. My parents have been in sales and management. They were successful. I'm going to go into this area because I have a genetic predisposition for this area, and I really don't like this area, and I'm not going to do it. Well, the reality is you can't be one or the other. You got to be both. You got to be a hybrid. Maybe you come into this side, or maybe you came into this side. But if you come into this side, you got to work on this. If you come into this side, you got to work on this. And it really is reflective. If you look at the top MBA programs, the majority of students in the top MBA programs are engineers. Why are they going to MBA school? Because they need to raise the capital. If they raise the capital and their products and services are successful, they want to build companies. They need to be able to manage company, and they need to be able to sell. So you have to go through this cognitive dissonance and the self-efficacy process to basically bring up your weak side to become a very strong hybrid individual that's basically good at both. So the outcomes, if you can do this psychologically, the outcomes are unbelievable. The outcomes are extremely powerful. If you can do all this up to this point, what happens is you end up having a persona. You end up having a strong personality. When you walk into a room, you command the room. People will respect you. They know you're an expert. You have the presence and the personality to be able to garner the respect that you deserve. You're going to walk in and you're going to be professionally dressed. Your dress is going to totally communicate right off the bat who you are and your attention to detail. You're going to have perfected the language in your communication to individuals at different levels of the organizations and other individuals, and know how to communicate with them and how to persuade them. Because once you can communicate and persuade and you have all of this, you will obtain charisma. Once you have the charisma, you will gain leadership. People will follow you. You will then obtain power, and you will be able to persuade people through your articulation to basically follow you and do what you need them to do, or do what you want them to do. And the best outcome of all is you will become a model for other individuals. You will have individuals coming up to you, asking you, can I work with you? Will you take me with you? Will you hire me? Will you guide me? Will you take me with you? And the power for you is you then get to decide who you're going to take with you and who you're not going to take with you. And that's going to be the saddest part, is because you're not going to take some people with you. Because they either don't deserve it, or they just, something's happened where you're going to have to make that decision. But to be able to bring people along with you and make them successful is extremely powerful and rewarding. And it will be your biggest asset moving forward in your career. So how do you do all of this? You got to be extremely organized. You got to know exactly what you're doing pretty much every second of the day, because you don't have time to waste time. Time will go by really quickly. So you have to have a plan. You got to set out a strategic plan that's got to go out at least 5 years, and you got to update it every year. So it's just a rolling 5-year plan. You got to basically put your priorities from high to low across the next 5 years. And you can't have this set in stone because things change and your life changes, so maybe some of the priorities are pushed down or pushed out, but you're still going to accomplish them. It doesn't really matter. I mean, I've accomplished things that I've had on my list for 30 years, and I got it at some point in time. You don't, sometimes some of these priorities are not easy to come by. You have to work on them, you have to plan them, and you have to be persistent and persuasive, because that's what you want and you're going to get it. And you will get it if you don't give up on it. You have to have tactical plans. 1, 2, 3 year plans laid out, priorities either for every 6 months or every quarter, and then these become your tactical and your operating metrics in which you're going to benchmark your success against in moving forward in your plan. You have to have an operational plan, which is basically lays out all the months ahead of you, maybe 1 or 2 years in the future, with key milestone dates that you're going to back into and allocate time so that you make sure that you get the GMAT in on time, that you take the test on time, that you hit your reference letters in, and that you spent a year basically traveling around looking at the schools in which you want to attend at that level when you go in, and be able to pick the right school and pick the right company. And then the most important is your weekly planning. My plans are totally booked for 2 weeks out, and then they taper off. I'm constantly booking myself full to create activity that generates activity, either economic activity or social or professional activities. So if you know that you have key milestone dates within the week, you've got to start blocking out time so that you can meet the deadlines for these critical time periods. And the world, what's really interesting too, is it basically runs the same. You have basically 5 a.m. in the morning to 8 a.m. to do whatever it is you need to do. It takes you an hour to get to work, you get there at 9. You work until 12, you get an hour for lunch, you get back at 1, you get off at 5, you gotta go someplace at 6, and then you have 6 to basically 11 or 12 at night to be able to do whatever it is that you need to do. And the whole world revolves around this. Same time periods, the same weeks, everything except for just the time differences. So you have to have time management to be a highly effective individual. You've got to be constantly planning. How am I doing on time?
You have 9 minutes.
9? Okay. Well,
you have more. You have half an hour till the class ends. But.
Okay, that's what I mean. You are going to be extremely successful individuals. You are going to make money. You are going to accumulate money. If you invest $1,000 a month for 40 years, based on 8% compounding, you will have $4.3 million in the bank by the time you're 65 years old. Pretty much guaranteed. So it takes discipline and to save, but you're going to accumulate money. And the great thing about the money is you'll be able to live a good lifestyle, and you'll probably be able to leave something to your family. That's if your shit doesn't get taken or stolen from you. And your shit will probably get taken, okay? Because if you become successful, you become a target for individuals. And when you accumulate money and you make a lot of money, you become a target. And it could be your sister, your brother, your uncle, your aunt, your mother, your father, could be your partner, could be anybody that's going to come after your stuff and try to steal it. Your real estate, your stocks, your business, you name it, they're going to try to get it. Because we're talking about money, and I've seen it. I've worked in the industry, I've seen it. I've seen it, it's tragic. But it happens, and you got to be really, really smart. So the first place you start is you're going to be working for organizations, or you're going to be setting up your own defined benefit or your defined contribution program to be able to invest pre-tax. The 401k, if you're lucky, you'll get matched by the organization, but at some point you're going to make too money and it'll phase out. So you only have a certain time period to fund these qualified accounts. You can put money in a 401k, roll it over into an IRA. If you're self-employed, you can put up to $53,000 in a SEP account, plow that money in per year. And the one I love the most is the defined benefit program. I can put pre-tax dollars of up to $250,000 per year in this thing. So after basically 8 years, I'm done. I got enough money in the pre-qualified side, I'm done. Don't have to worry about it. And since you're so young, you want to be investing aggressively. Okay, equities, all right, not bonds or anything. And now you can actually put real estate in your IRA. So you can even put alternatives in there now because the accounting's in place. So at some point in time, you're going to phase out of here and you're going to have to put your money after tax somewhere. It doesn't make sense to put money safe in the qualified side. So you're going to have to put money somewhere after tax. And that's usually going to be businesses, stocks, real estate, and other areas, but those are the main categories. All of a sudden, one of these days, you're probably going to get a wealth effect. You invested right in real estate, you invested right in the stocks, you invested right in the company, and you got stock options, and you get a wealth effect. All of a sudden, what do you do with all that money? Well, then what you do is you take that money and you bring it down below the line and you put it into safe after-tax vehicles, such as muni bonds, preferably California, because you don't have to pay federal or state income tax on the interest that you generate from muni bonds. And San Francisco Bay Area is the #1 muni bond place in the United States. It has the highest concentration of any place in the United States. You can also plow money if you're healthy and young enough in cash value life insurance. It's a great place to put money. Or variable universal life. And you can put money into guaranteed and fixed annuities, basically setting an annuity and an income stream that is going to provide you and your family enough money to live at the standard of living that you're accustomed to or higher for the rest of your life and their life. So how do you do it? How do you accumulate and asset protect? Well, there's two sides of the toolbox. There's the risk management side. First thing, you got to get term life insurance, preferably convertible term, so that I can get the $2 million life insurance and at some point convert it into a custom whole life or a variable universal life and start plowing a ton of money into this thing. And as the value of the portfolio goes up, the cash value goes up along with the death benefit. It's also the life insurance contracts are asset protected. If you get sued, they can't come after the death benefit, they can't go after the cash value in the life insurance. So you've asset protected it, and it's an investment vehicle, and it's a life insurance product. You'll probably need long-term care insurance unless you make $4 million, because when you go into a congregate care, it's probably going to cost you $400 a day, because you can't do 2 of your daily functions. You're basically disabled at the age of 72 or 82. And if you did it right, you basically funded this pre-tax dollars through your C corporation because the premiums are tax deductible based on IRS code. You're going to need, if you go work for a company and you work your way up, they're going to slap disability insurance on you. They're going to slap life insurance on you too, because you're a key person. And if something happens to you and it takes out some of their income or destroys some of their intellectual property, they want to be compensated and have enough money coming in to basically repair the damage from whatever happened to you. And then if you're going to own real estate, you're going to need property casualty insurance because the property's worth $5 million, but you only insured it for 2, and there was a fire and an earthquake, and to replace it, it's going to cost $5, but you only have $2 million in insurance. You're going to have to come up with $3 million out of your pocket to basically rebuild the property. If you're going to have a business, you're going to need business umbrella insurance because you're going to get sued. There's going to be creditors coming after you. There's going to be predators coming after you. And you're going to need to stick the attorneys on them to get rid of them. And the umbrella insurance brings in the attorneys to take out these guys and get rid of them. And then lastly, keep going. The investment management side. We talked about the qualified accounts, rolling over the 401ks. Do not leave your 401k with any of your companies. Take them with you, roll them over into a self-directed IRA. You can put them into mutual funds, but the problem is when the market takes a dump, your retirement account is going to go down too. So what I've done, a lot of my clients have rolled the money into a variable annuity with a guaranteed investment protection rider. It's basically a 12-year put option. Costs you a point. So if you put 100 grand in and the market goes down and the value of your portfolio is worth 50 grand, the insurance company will write you a check for 50 grand, so you didn't lose anything. You bought a put. And basically as the market goes up, you lift the put option up and you lock in your wealth over a 5 to 15 year period, and it'll run for another 12 years, and then you're done. You can also roll these qualified monies into a guaranteed future income annuity. I'm 55 years old, I got $1 million, I don't need the money until I'm 75, so I got 20 years. I give the insurance company $1 million today, and they pay me and my wife $100,000 a year when I turn 75 for the rest of our lives. So we never run out of money. Our standard of living never goes down. So we can allocate some of this qualified money into these guaranteed products that were invented because of the financial crisis, because people were freaked out that another one was going to come and they can't afford another financial crisis. Imagine if you were retiring in 08, 09 and 70% of your stock portfolio went down. You can't retire. You're done. But if you had the money in these guaranteed products, you were fine. You can also invest, at some point you're going to move into the non-qualified side. Now you can put money in a stock brokerage account. Securities are highly liquid. I can sell them off at any time and just pay the capital gains. So if you need to buy a M5 or a house or your kid's education or a down payment on a house or a business, you can put the money in the brokerage account, manage the account, get some return on it, and then liquidate it and use the liquidity to do whatever it is you need to do. But again, you're subjected to market risk. You can also put money in these variable guaranteed annuities. People love these things because there's no limit that you can put in these. And the money that you put in accumulates tax-free. And when you do start pulling the money out in the future, it's going to be counted as income and you pay the tax at the income tax level. But again, you got to be careful not to overfund these things or take too much income. There's got to be tax strategies here because you don't want to be pushed in the upper tax bracket and then the alternative minimum tax along with California tax, and you're totally screwed. If you can invest in these guaranteed future income annuities, since you paid for them in after-tax dollars, 2/3 of the premium that you return is tax-free because it's on a FIFO basis of accounting. It's the money you put in is being returned back to you in proportion. And you can also invest in fixed annuities. How much time do I have?
20 minutes.
Perfect. Lastly is you're going to accumulate the wealth, or your grandparents and your parents have already accumulated wealth on your behalf. You may or may not be in the lineage to receive that money, and I wouldn't guarantee it, okay? And the reason why I wouldn't guarantee it is, do you know where the money is the first question. Do you know where the money is? Have you had those conversations with your parents? Where is the money and how is it going to work if something happens to you? Because if you don't know how it works and you don't know where the money is, somebody is taking it. Maybe it's your sister, your brother, your uncle, your father's, your grandfather's business partner, maybe forged documents to basically get on the title for the property and you don't even know it. Maybe there are beneficiaries that were forged and signed on the life insurance policies and you don't even know it. Maybe the brokerage accounts, the beneficiaries of the brokerage accounts have your sister's name on it and you're not even on it. That's a problem. So the first thing you need to do, and this is my advice to you, is if you plan on inheriting any money from any of your grandparents or parents, you better know where the money is. You're adults now. You're adults now and you got to take responsibility. You got to know where the money is and you got to know how it's going to work if something happens. Because if it's not written down in the documents and in the contracts and in the trust documents and on the accounts, somebody's going to swoop in and take it. And if it's not your family or your friends or your business partners, it's going to be the federal government. Because if you don't do the planning, they're going to steal your shit, guaranteed. They will swoop in and take it. So what do you do? Well, the first thing you're going to have to do is figure out what assets are outside of the trust. Because I got business interests and I got real estate interests. Where in the partnership documents they state that I cannot put those interests within a trust. So that's a problem. So I'm gonna have all these assets, or you have assets outside the trust. And the problem with these is when the principal passes away, it triggers an event, and there may be a tax due by the government. We'll say, oh, the principal died, they have these assets outside the trust. You're gonna have to, if you wanna keep the assets, you're gonna have to pay the tax. Well, most people don't have the money to pay the tax on these assets. So they say, I'm gonna have to liquidate these assets to pay the taxes. Well, sorry to tell you that these are highly illiquid assets, and you're gonna have to sell them at a liquidity discount. And you may not even have enough money after you sell off the assets to pay the taxes. So basically what you and or your parents or your grandparents did was leave you a tax liability because they didn't plan it correctly. And on the triggering event, if you sell the assets, it also triggers any leverage or mortgage or margin that you may have that need to be paid off. So you have the debt and the taxes that you need to pay. If you have wholly owned assets, business interests, you own the company, you own the shares, you own the real estate outright, you can put them into an irrevocable trust. Why would you put them into an irrevocable trust? Because an asset protects if somebody tries to steal your shit. They can't pierce the veil to get to the income, to get to the assets. Also, when the principal passes away, the assets go to the heirs at a stepped up basis, and you do not pay estate taxes or income taxes or gift taxes. It goes to you tax-free. So what's the solution here? We got a problem. So this is okay, I got that. Oh, but there might be mortgage and margin on these two. So when the principal passes, I might have to, if I'm gonna sell them off, I might have to pay off the mortgage and the margin. Down here, I'm definitely gonna have a tax liability, and I'm definitely gonna have to pay off the mortgage and the margin and leverage. So what's the solution? The solution is you set up an irrevocable life insurance trust. The trust is the beneficiary of the life insurance policy. The death benefit of the policy basically matches the tax liability and the mortgage and the margin. Yes, you're gonna have to skim off some of the income coming off of the assets, which means your expected return is gonna be less. But the risk, you've just hedged off the market risk, the tax risk, and the leverage risk. Once the beneficiary, the trust gets the monies, they extinguish the taxes, they extinguish the leverage, they extinguish the leverage, and all the assets go to you tax-free and leverage-free. Do you think people are doing this? Do you think people are doing this? Yeah, they are. They're called the Rockefellers and the Hunts and the Microsofts and the Salesforce. Yeah, they're getting the best planning. These people know all of this stuff because they have the best tax and trust attorneys and accountants and advisors working for them. But I'll tell you what, I don't know about you, but I love taxes. I mean, I don't believe in this. I love taxes. I love income taxes. Could be between 39 and 70%. I love federal, state, and local taxes on top of that. Oh, I love capital gains tax, it's 20%. I love recapture tax because you have to depreciate the real estate for the last 30 years, only 5%. Obamacare tax, roughly 10%. Oh, transfer tax, this is the cutest little tax. That's the one I love the most, is the transfer tax. They get you 10% on when you start trading your businesses and your real estate. And then retail sales taxes could be as high as 10%. So you're gonna get totally hosed on taxes, unless you tax plan and you figure it out and you protect yourself. And lastly, you have to have the estate set up and protected. You gotta have a will. That's the first thing you need is a will. It's not gonna circumvent probate, which means the government's still gonna screw with your stuff. But at least you got the will in place and everybody knows what they're gonna get. You definitely need a medical directive within the will. Because when my dad was sick and dying, he was basically taking down $1 million every 6 months in healthcare costs. Almost totally took us out. The insurance paid for a lot of it, but we didn't have to use the medical directive because he did pass away. But if he lived for 2 years, we were done. We were totally taken out if we didn't have the medical directive. The living trust is not an irrevocable. It tells where the assets are going to go. It circumvents probate. Irrevocable trust, we already talked about it. Oh, these are the two you're gonna love. The dynasty trust and the generation skipping trust. This is when you get the call from your parents that basically state, congratulations, son, we're so proud of you, you're so successful. We're gonna tell you, because you're so successful, we're not gonna leave you any money. We're gonna leave all the money to your grandkids. So we're gonna generation skip. And we're gonna set up the grandkids, because you're fine. And then lastly, there are intentionally defective and other types of trusts that are basically engineered products to basically asset protect or transfer title or, to mitigate taxes. So you have to understand the tax code. How much time do I have?
12 minutes.
Okay, perfect, we're right on time. No, that's basically it.